Okay, some options are traded on exchange and others are traded on OTC. But as an option trading exchange, we could think of CBOE, which is part of CBOT, the oldest and the biggest, as an option exchange. But then we have AMEX. AMEX is used for option trading, but then this exchange was taken over by NYSE Euronext. Before it was taken over by NYSE Euronext, and AMEX and NASDAQ got combined. And I'm going to read it when time allows. And the Philadelphia Stock Exchange is also used for option trading. And then International Securities Exchange, which is known as ISE, which is a part of Eurex, is going to be used for option trading as well. Okay, sorry. I wanted to, since this is important, compare option with future and forward and swap. Like I said, future forward swap gives the holder the obligation. When you make an agreement, you are obligated to do what you agreed. Whereas in option, you have the right. Option gives the holder the right to buy or sell. So if situation is such that you don't feel like exercise your right, then you don't have to, because you have the right. And we talk about how these derivatives are used, but more specifically, derivative could be used for trading. And there are 3 different types of trading: hedging, speculation, and arbitrage. And advanced risk management. With advanced risk management, this is sort of for usage. But for trading, as far as trading is concerned, and hedging, speculation, arbitrage are sort of 3 reasons for trading. And you heard about hedge fund, right? Hedge fund can be contrasted with a mutual fund. If you, in the United States, if you collect money from more than 100 people, then it's mutual fund, and you have to follow a lot more regulation, since more people's money got involved. But if you collect money by less than 100, then a lot less regulation applies. That's hedge fund. So hedge fund, in the case of hedge fund, you could reduce risk when you trade, and you could willing to bear some risk and make money. That's speculation. And you could do some arbitrage. So hedge fund, they trade derivatives for all 3 trading reasons: hedging and speculation, arbitrage. But sometimes trader got tempted. When they're supposed to hedge or arbitrage, they're tempted to do speculation. Then a large losses can result. And bearing is one example. And as an hedging example, here I show an example of long hedge. here US company supposed to pay 10 million pound for import. So in the future you're supposed to you need 10 million British pound, but in a future point in time you're not sure about this exchange rate. So what you do is you buy British pound now and make a long forward contract. Okay. And put option could be used as an hedging example. Suppose you have 1,000 Microsoft share and currently $28, and 2 months put with a strike price of 27.5 cost $1. And suppose investor decide to hedge by buying 10 put option, then Microsoft stock price fall below 27.50. Then with this put option you have the right to sell this Microsoft that happened to fall below 27.50 at which price? At this strike price of 27.5. So next graph shows how put option hedge. Okay, this is Microsoft stock price. It could go up or go down. Without put option, your wealth is going to be dotted line. With put option, your wealth is you got protected by this from this downside risk. Okay. And speculation. With derivative, you could speculate even more. Here is an example. Suppose you have $2,000 and you want to invest in Amazon stock, and you expect stock price is going to go up. Current stock price is $20 and call option price is $1 with a strike price of 22.5. If you invest in stock price, since current price is 20, you could buy 100 shares, right? So if stock price goes up to 30, then since current price is 20, you make $10 per share. If you buy 100 share, you make $1,000 profit. But in a case of option, since option is only $1, with $2,000 you could buy 2,000 option. Okay, if stock price goes up to 30 as you expected, then with each option you make $7.5 profit. Since you have 2,000 option, you make a $15,000 profit. Okay. If you exclude your options payment $1, your net profit is going to be $13,000. So options is more speculative and seems more lucrative. But the problem is if stock price fall, then your initial investment $2,000 is gonna be gone. Okay. And arbitrage is, what did I say about arbitrage? It's making money, but you don't have to bear any risk. Suppose stock price is quoted £100 in London, and in New York $182, and current exchange rate is 1.85. Then there is an arbitrage opportunity. Okay, this is how. Okay, given the time constraint, we're going to stop here.